There is a Chinese brand quietly climbing the global sportswear ranking. It's not Nike, it's not Adidas, it's called Li Ning. And today, it's ranked number 3 in China, just behind Nike and Anta, and already ahead of Adidas, which has been losing serious ground lately. But this story isn't just about market share. It's the journey of a former Olympic champion who built a brand that now blends technical innovation, urban style, Chinese identity, and global ambitions. In this video, we are going to step back and ask, what is Li Ning really? We will look at the brand's history, its transformation, and its strategic positioning in one of the world's most competitive industries. Then we will dive into a full financial breakdown. And finally, I will share my opinion on the stock. Is it an opportunity at the current price? Or is it too early to get in? Quick disclaimer before we begin. This video is not financial advice. It's a detailed, rigorous breakdown of a real company. But ultimately, you're responsible for your own investment decisions. So always do your own research before investing. Alright, let's get into it. When we talk about Li Ning, we're first talking about a man. A former gymnastics legend, a 6-time Olympic medalist, and one of the biggest sports icons in 1980s China. In 1990, he founded the brand that bears his name, with a clear ambition to build a national alternative to global giants like Nike and Adidas. In the 2000s, the brand grew fast. It sponsored national teams, opened hundreds of stores across China, and quickly became a major player in Chinese sportswear. But by 2012, the cracks started to show. Too many stores openings, weak logistics, and falling profitability. That triggered a massive restructuring phase. Stores were closed, the strategy was refocused, and the brand started to repositioning itself. The real turning point came in 2018. Li Ning shifted toward a more premium model, developed its own proprietary technologies, and built a new identity based on modern Chinese culture. That marked a brand new era, more structure, more consistency, and above all, more ambition. Today, Li Ning is the third largest sportswear brand in China, behind Nike and Anta Group, but already ahead of Adidas. So what does the market look like today? In 2024, the breakdown is roughly Anta Group around 23 to 24%, Nike around 18 to 19%, Li Ning between 10 and 11%, and finally Adidas down to 9%. 10 years ago, Li Ning was still behind Adidas, but today it's the second biggest domestic player in China, right behind Anta. Li Ning operates with what's called a semi-integrated model. That means the products are designed in-house, right in China, by the group's own R&D teams. But when it comes to manufacturing, it's outsourced, mainly to southern China, Vietnam, and Cambodia. This setup keeps the company agile and cost-efficient, while still retaining tight quality control over the products. On the distribution side, Li Ning runs a dense physical retail network. As of December 31st, 2024, the group had a total of 7,585 stores in China. About 30% of these stores are directly operated by the company, mostly in large cities. The remaining 70% are run by franchise partners. Even the stores managed by the company are usually leased, not owned, part of a deliberate asset-light strategy. That allows the brand to adjust its footprint quickly, depending on store performance. Alongside its physical stores, e-commerce is a huge part of the business. Today, nearly a third of Li Ning's total revenue comes from online sales. The brand is present on all the major platforms: Tmall, JD.com, WeChat, and Douyin, and it runs a highly refined data system behind the scenes. This system allows them to track real-time sales, adjust restocking almost instantly, and test new product launches with impressive speed. They call it sell-through management, and it's become a major driver of profitability across their network. On the technical side, Li Ning has built up a real innovation capability, especially in footwear. Most of their performance technologies are developed in-house, and that's a key differentiator in the Chinese market. For example, Boom technology for cushioning, carbon core plate for propulsion, Boom fiber for the uppers, and ultralight for lightness and comfort. These innovations help the brand stand out from competitors, and they also justify a steady increase in average selling prices, in line with Li Ning's shift toward premium positioning. Let's talk now about materials. Like most sportswear companies, Li Ning relies heavily on a few key raw materials: cotton, polyester, and synthetic compounds like EVA and polyurethane, especially for soles. These are commodity-based inputs, and their prices can fluctuate a lot. But here is what's interesting. Li Ning does not use financial hedging to lock in material costs. Instead, the company adjusts its product mix in real time to protect its margins when input costs rise. How? By increasing the share of high-value items and reducing the exposure to models that are more sensitive to price spikes. It's a more operational, hands-on approach, but so far it's worked. One thing that makes Li Ning stand out is how much it spends on marketing. We're talking about 9% to 13% of annual revenue, which is a very high for the industry. But that investment isn't random. Li Ning follows a strategy that's heavily digital, highly targeted, and very platform native. You'll see the brand everywhere online in China, on Douyin, the local TikTok, on WeChat, Xiaohongshu, and other lifestyle platforms, through live commerce, influencers, short-form videos, and even in interactive campaigns tailored to each demographic. It's not just spending money, it's building a digital-first ecosystem. And beyond social media, Li Ning also has a historic partnership with the Chinese Olympic Committee, a relationship that gives the brand legitimacy, visibility, and a powerful national identity. In short, This is a brand that knows how to speak to its audience and how to stay culturally relevant in one of the fastest moving consumer markets on earth. So what's the core of Li Ning's model today? It's built on 5 pillars. A strong brand, deeply rooted in Chinese culture and identity. A structured, evolving product offering. Solid omnichannel capabilities, both online and offline. Real technical innovation, especially in footwear. And a unique cultural positioning that really resonates with younger Chinese consumers. It's not just a company that sells sneakers, it's a brand that embodies a generation, and that's powerful. But there are also real challenges ahead. The company still relies heavily on the domestic Chinese market. Competition is fierce, especially from Anta. It has exposure to raw material costs with no hedging, and in a fast-moving fashion culture, it needs to constantly stay relevant. So yes, Li Ning is solid, structured and profitable, but it's also playing in a high-pressure market. That's the strategic backdrop. Now let's take a look at numbers. Over the past 10 years, Li Ning's revenue has seen massive growth. Back in 2014, the company was making just 6.73 billion RMB. By 2024, that number had climbed to 28.68 billion RMB. That's a compound annual growth rate of plus 15.2%. Which is very strong for the retail industry. Now, it's worth noting that 2014 was a recovery year, following a major restructuring. But the real acceleration came in 2021, right after COVID. That year, revenue jumped by plus 56%, a record. Why the surge? Post-lockdown health awareness among Chinese consumers, strong government support for domestic brands, and Li Ning's own strategy combining e-commerce and cultural branding. In 2022 and 2023, growth began to slow, plus 14.3%, then plus 7%. Reflecting a tougher economic environment. But there was not a sharp drop. In 2024, revenue still grew by plus 3.9%. That's not spectacular, but in context, it shows the model is resilient even in a cooling market. To really understand Li Ning's growth, you have to look at the bigger picture. Because the sportswear market in China isn't just growing, it's growing much faster than GDP. While the Chinese economy expands at around plus 5% per year, the sports and active lifestyle market has averaged between plus 10% and plus 12% over the past decade. That's more than double, and this trend is being amplified by the rise of the middle class, combined with a growing cultural emphasis on health, fitness, and an active lifestyle. So what does this mean for Li Ning? Well, if household incomes in China keep growing at around plus 5% per year, it's realistic to expect Li Ning's to keep growing at plus 8 to plus 10% annually, even without expanding internationally. In other words, the tailwinds are structural, and they are not going away anytime soon. the past decade, Li Ning's gross margin has moved through two clear phases. In 2014, margin stood at 44.6%, already solid, but still room for improvement. Then came the boom years. Gross margin peaked at 53% in 2021, right after the post-COVID growth surge. Since then, it's been declining, 48.4% in 2022, then a slight rebound to 49.4% in 2024. So what's behind the dip? Mainly more aggressive promotional activity and stronger competition across the market. But even at 49%, Li Ning's margins remain very strong by industry standards, a sign that its business model still holds up even under pressure. Now, if we zoom in on EBITDA margin, the picture is even more telling. In 2014, Li Ning was still recovering. EBITDA margin was actually negative at minus 4.8%. Then came a turnaround, 5.6% in 2015, 28.5% in 2021, which marked the post-COVID peak. Since then, we've seen a gradual decline. By 2024, EBITDA margin had fallen to 22.2%. What caused that drop? Mostly rising marketing and payroll expenses, combined with a sluggish consumer environment in China since 2022. Bottom line, Li Ning is still highly profitable, but its operating leverage is clearly under pressure. From 2015 to 2024, Li Ning's top line more than tripled, and earnings per share followed a similar path. EPS rose by plus 176% over the period. It's a strong performance, but slightly below the growth rate of total revenue. Why the gap? One key reason is dilution. Over that same period, the number of shares outstanding increased by almost 20%. So even though net profit increased, that growth was spread across more shares. Still, the trend is clear. Li Ning is a company that's grown consistently and profitably. At the end of 2024, Li Ning's balance sheet is rock solid. The company holds 18.1 billion RMB in cash and less than 2 billion RMB in debt, most of it related to lease obligations. In short, it's in a strong net cash position with no pressure from lenders. So what does it do with all that cash? It invests, it pays dividends, but most importantly, it makes that cash work. A big chunk is placed in term deposits and low-risk financial products, meaning the treasury isn't just sitting idle, it's earning returns. And let's not forget, there's still 911 million RMB from the 2021 equity raise, earmarked specifically for supply chain upgrades. Since 2017, the company's net cash has grown by more than 13 billion RMB, reaching a record high in 2024. That cash now represents around 50% of the market cap. Bottom line, Li Ning isn't just cash rich, it's making that cash count. Since 2020, Li Ning has seen a clear rise in tangible net asset per share, from 3 RMB to nearly 10 RMB by the end of 2024. That's a very positive sign. It means the book value per share has genuinely strengthened, not just because of accounting tricks, but because of real capital accumulation. At the same time, the company still owns very little physical infrastructure. Its property, plant, and equipment level remains low, consistent with its asset-light model. In short, Li Ning is growing its net worth while maintaining operational flexibility. One of the most impressive improvements over the past decade is how Li Ning manages its working capital. Back in 2014, the company needed 96 days to fund its operating cycle, but by 2024, that numbers had dropped to just 35 days. That's a massive gain in efficiency. The improvements came mainly from two areas: better inventory turnover and tighter control over accounts receivable. It's the kind of operational discipline that doesn't always show up in headlines, but makes a huge difference to cash flow and returns. Between 2014 and 2024, Li Ning's capital expenditures stayed relatively modest. Annual capex rarely exceeded 1.5 billion RMB. As a percentage of revenue, it usually hovered around 5% to 6%, which is considered low for a company in retail and apparel. But that's entirely consistent with the company's strategy. Remember, Li Ning doesn't build factories, and it doesn't own its stores. It rents. That's the essence of its asset-light model: low fixed costs, high adaptability, and better capital allocation. Even though profits declined slightly in 2024, Li Ning's free cash flow per share actually went up sharply. Why? Because the company cut back significantly on capital expenditures. Capex went from 1.6 billion down to 886 million RMB. That shows real financial discipline. Li Ning adapted to the market cycle, reduced spending, and still generated strong cash. That kind of behavior is exactly what you want to see in a company under pressure. Return on equity is a key metric for long-term investors. In 2021, Li Ning's return on equity peaked at nearly 27%. But by 2024, it had fallen to 11.9%. That decline may look steep, but it's not just about lower earnings. It's also because shareholders' equity increased significantly, thanks to retained profits and capital raises. So even if returns look lower on paper, the company is now more capitalized and still producing solid performance relative to equity. At 11.9%, Li Ning's return on equity remains respectable and well within the zone of quality companies. In 2024, Li Ning paid a total dividend of 58.5 RMB cents per share, which translates to a 3.8% yield based on actual share prices. The payout ratio sits at exactly 50%, a level that considers it conservative and sustainable. There are no share buybacks for now, but the dividend is clear, stable, and well covered by earnings. So for long-term investors, that's a reliable income stream, backed by a healthy balance sheet. One last piece of the puzzle: valuation. Over the past few years, Li Ning's stock price has been extremely volatile. We saw the post-COVID boom, with the stock shooting past 105 Hong Kong dollars at its peak. Since then, it's pulled back sharply, now trading around 17 Hong Kong dollars. Statistically, that's slightly below under its long-term price trend. The result? A PE ratio of about 13, which is actually quite attractive given the company's quality, cash position, and long-term structural drivers. In short, this is a stock that's gone from overhyped to potentially undervalued. So where does all this leave us? Li Ning is the story of a Chinese brand that reinvented itself, building on its sports DNA and turning it into cultural and commercial force. It's a profitable business, debt-free, with strong cash reserves and solid free cash flow. And that cash isn't just sitting idle. It's put to work, invested across the business, and even earning returns. With a PE ratio around 13 and a model that's still generating real value, the risk-reward profile looks compelling. Is it a perfect stock? No. It still relies heavily on the Chinese market, and growth has slowed in recent years. But for medium-term investors looking for quality in a growing sector, Li Ning looks like a reasonable opportunity. Not a rocket, but a solid name to watch. Let's recap quickly. Li Ning's strengths are strong brand aligned with Chinese cultural identity, agile and lean business model, proven resilience after the 2010s crisis, excellent financial health, high cash, no net debt, treasury invested, advanced omnichannel system, and growth driven by structural lifestyle trends. And its weaknesses are still a young brand with low international visibility, heavy dependence on the domestic market, smaller scale versus global giants like Nike, limited diversification outside core business, no commodity hedging with margin exposure, and must stay culturally relevant in a fast-changing market. Thanks for sticking with this deep dive until the end. If you found this analysis useful, feel free to like, subscribe, and share this video. It really helps the channel grow. And let me know in the comments, do you own Li Ning? Do you considering investing? See you soon for another deep dive.